All right, next up, folks. So we've been talking a lot about REITs. We're going to be moving on because we've been seeing some really big moves in Chinese stocks of late. So you might be thinking of dipping your toes in. Lots of volatility. If you're not familiar with the Chinese markets, it can be quite challenging to figure out exactly which counters you should be looking into. Instead, what you can do is to diversify your risk by getting exposure to the Chinese market through ETFs instead. And to let us know which ETFs to look out for, we have with us Ms. Chloe Halim, who's a research analyst from iFAST. Chloe, over to you.
Hey, thanks a lot. So hi, everyone. My name is Chloe, and thanks for taking the time to join us on a busy Saturday. And again, I'm a research analyst from iFAST Singapore. So for the session today, I'll actually be sharing about some of the China-related ETFs that are listed on SGX. And we all know China equities in particular, they had an especially rough year in 2021. So currently, we think that China's stock market is actually not far from the bottom, and hence investors can actually consider buying some of these ETFs, which I'll be sharing more about later, to actually ride on this upturn. So exchange-traded funds or ETFs, they offer investors a simple and easy solution to get exposure to Chinese stocks in various sectors. And today, I'll be taking a closer look at the Lion Ocbc, Hang Seng Tech ETF, as well as the Nickel AM presentation. Let's take a closer look at the ICBC CSOP FTSE China Government Bond ETF. And investors can all easily access these ETFs as they are all listed on the SGX exchange. So to begin my presentation, let's first take a look at the Lion Ocbc Hang Seng Tech ETF. So till today, China's tech crackdowns remain one of the most talked about issues within the equity markets. So with this in mind, let's look at some of the reasons behind the crackdowns, which have contributed to the Hang Seng Tech Index plunging since its peak in February 2021. As we all know, a series of regulatory crackdowns was imposed by the Chinese government on big tech companies. And this brought about and sent shudders across the whole stock market. It all began in late 2020 with the cancellation of Ant Group's IPO, and the regulations continued to heighten through 2021. I'll be highlighting some examples. So in April 2021, Alibaba was actually slapped by regulators with a record fine of about 2.8 billion USD for violating antitrust laws for the use of its 2-choose-1 exclusivity contracts on merchants. While in July 2021, the government actually banned Tencent Music from owning exclusive rights within the online music industry. And the crackdown was even extended to that of the private education sector, where sweeping reforms were introduced, some of which include requiring all these private education institutions to register as non-profit entities. So what this means is that moving forward, these institutions will not be able to pursue IPOs or take in foreign capital. And these are just some of the examples of the regulations which was imposed on the tech sector and has weighed on the overall sector as well as investor sentiments. But looking at the regulations, we do believe that the regulators' intent is actually not to stifle the growth of these tech companies, but rather is instead to actually safeguard consumer interests and ensure the sustainable growth of the sector. So firstly, the regulations help to safeguard consumer merchants as they help to promote fair market practices, and this is all crucial for successful long-term sustainable growth. So as over the past years, we find the case that many of China's big tech companies, they've grown significantly and they gain influence over consumers and businesses to the point where it became nearly impossible for consumers as well as small businesses to navigate their daily lives around the tech ecosystems. And these are operated by the likes of Tencent as well as Alibaba. But yet, despite this dominance, little regulation was imposed on these tech giants before all these crackdowns. And this has led to actually unfair treatment for customers as well as merchants. So I'll be highlighting this example of this anti-competitive two-choose-one practice, which actually forces the online merchants to choose only one platform as their exclusive distribution channel. And this will benefit the e-commerce platform, but come at the expense of that of the consumers as well as the online merchant themselves. So if left unchecked, the power will remain at the hands of these large big tech internet platforms and would help to facilitate further of such market abuse, which we have seen in the past. And moreover, with the power constrained within these big tech players, we could prevent a lack of competition. It could lead to a lack of competition within this whole industry, and this would impede innovation in the industry going forward. As such, we think that a healthy dose of regulation in this sense is not entirely unjustified as well as unreasonable. And last but not least, not to mention that economic regulation has always been part of healthy functioning markets. And we believe that these regulations are actually meant to position China for further sustainable long-term growth in the future. Another thing we want to highlight is that rather than to hinder the growth of the tech sector, the government actually remains fully committed to digitalization and innovation, and we see this in their ambitious 5-year plan. So this 5-year plan, in essence, is actually a grand strategic blueprint for China for the next half decade. And as investors all around the world, they closely watch this as it provides a close glimpse to what the future lies ahead for the country. And by 2025, the government actually aims to have the digital economy account for about 10% of China's newly added economic output, and to actually become the leading innovative country by 2035. The government also laid out multiple goals, and this includes being more technology self-sufficient and to actually become the world's technology leader. And these goals become especially important when we see that tensions with the United States actually continue. So China has increasingly stressed the importance of goals such as being more self-sufficient. And one of the main projects that the government is actually pushing forward is that of this digital yuan project. So this is a project that actually gives us a glimpse of China's ongoing digitization efforts. And this digital yuan rollout would mean that China would also become the first major economy to introduce a sovereign digital currency, and all of which will help to accelerate their digitalization attempts. So not to mention, going forward, we also think that a turnaround is in sight for China tech names, and here are some of the reasons why. So we think that going forward, regulatory pressures should be easing, especially with what has gone on in the past, and we see a roundup of investigations for companies. So companies have made the necessary ratifications, and a lot of the pending investigations have actually been given the final verdict. And this actually fits with the timeline given by China's Ministry of Industry and Information Technology of a 6-month review of the internet companies, which actually commenced on July last year. And we find that over 68 internet companies, which includes that of Baidu, Alibaba, Tencent, ByteDance, Weibo, they've actually completed their ratification and are now in compliance with the new regulatory frameworks. Moreover, more recently, China is actually vowing to ease their crackdowns after the recent market turmoil saw another massive sell-off. And we think that this is needed and actually is necessary, as going forward, China actually has set a rather challenging goal of around 5.5% this year. So they actually held a meeting among the top Chinese officials, and this was actually chaired by the Vice Premier Liu He, who's also the country's top economic official. And he came forward to actually provide reassurance that the sweeping crackdowns on internet companies was actually nearing an end, and this signaled a change in policy direction and was welcomed by the markets. So with China's State Council now vowing to keep its stock market stable, stocks across Hong Kong and China, they staged a stunning rebound. So if you see here in the chart, the Hang Seng Tech Index, it actually jumped by more than 20% following the announcement on 16 March this year. And we see that a lot of the Chinese tech firms, they soared by a record. You see companies like Alibaba as well as Tencent, they actually gained more than 23% right after the announcement was actually being made. So given that Chinese tech equities have all seen intense selling pressures recently, amidst all these regulatory fears in particular, we think that the strong recovery lies ahead for the sector. And this is mainly because for some of the reasons which I touched on earlier, such as the ratifications being done, as well as investigations that are coming to a close. And more importantly, I think the main thing to highlight is that China is now openly displaying support towards the easing of crackdowns in the year ahead. And beyond that of the easing of regulatory crackdowns, I think another thing we would like to actually discuss is that of the listing concerns. Especially recently, these prospects of the listings of the US listed Chinese stocks have spooked a lot of investors. And again, I'd like to share that we think that these fears could perhaps be overblown for various reasons. So firstly, the China Securities Regulation Commission actually reinforced their support for US listings. And they stated that Chinese companies should be free to choose where to list as long as they abide by the laws of both jurisdictions. And secondly, even in the case of a delisting, companies have plenty of options, such as the China's Shanghai stock market or the STAR market, as well as the Hong Kong Stock Exchange to actually list their shares. Moreover, I think the earliest delisting would actually take place 3 years from now, as the US rules state that the foreign companies may only be delisted should they fail to comply to the audit requirements for 3 consecutive years. But nevertheless, these downside risks persist, and the news of this delisting has continued to dull investor sentiment and could affect the valuation multiples, meaning that investors will probably lower the multiple they will be willing to pay for China tech names. But again, even in the event of the delisting, companies that already have dual listing, they can actually elect to convert its ADR into Hong Kong listed shares, and so investors will likely to be impacted very little. So with all this in mind, as well as what was mentioned earlier, we think that moving forward, this continued healthy fundamentals of the big tech companies within China, as well as the easing of regulatory pressures this year, should mean that the outlook for China tech stocks should begin to look more promising. And with this in mind, an ETF which investors can consider investing is this Lion Ocbc Securities Hang Seng Tech ETF. So this is an ETF which is listed on the SGX exchange, and it aims to replicate the performance of the Hang Seng Tech Index. And this index represents 30 of the largest technology companies that are listed on the Hong Kong exchange. So this ETF has an expense ratio of 0.68%, and they're available for trading in both the SGD as well as the USD currency. So again, I'd like to reiterate that given the steep sell-off in Chinese tech stocks, we think that valuations are too cheap to be ignored. So investors who are positive on the long-term growth of the sector and see this as a good opportunity to actually go about to accumulate positions within for China tech names. They can actually make use of this opportunity to add to their positions by the use of this ETF mentioned above. And to get a better idea of some of the companies within this Lion OCBC Hang Seng Tech ETF, here are also the top 10 names. And there are many notable names such as Xiaomi, Alibaba, Tencent, and JD.com, which are also some of the biggest names within the China tech space. So moving on, I'll be sharing about a second ETF that we'll discuss today. So China's regulatory actions, they've put investors on high alert. And of course, while we remain positive on the long-term prospects of China's tech sector, we do note that not everyone might be comfortable with this volatility that comes along with this uncertain regulatory environment, especially as we all have seen this in the past. So as such, instead of looking at this, they could perhaps also look at other sectors that will instead benefit from China's development plans. And one of which we actually wish to highlight today is that of China's electric vehicle or EV sector in short. So this is a sector that is aligned with the government's long-term priorities. And within the next few slides, we'll be sharing why this is the case and also why China's EV sector is one to watch out for. So to start off, China is responsible for 27% of the world's greenhouse gas emissions. And this is a rather huge number, especially when you consider the fact that this is more than that of the US and EU combined. But moving forward, the country has plans for a greener future. So the government has set a lofty goal of aiming for peak CO2 emissions before 2030 and achieving carbon neutrality before 2060. And becoming carbon neutral means that China will actually have to reduce its carbon emissions by as much as 90% and offset the rest through natural systems or technologies that absorb more carbon from the atmosphere than what they emit. Given that electric vehicles or EVs, they produce fewer emissions compared to conventional vehicles which are powered by diesel or gas, they're actually expected to play a growing role in meeting this climate change goal. And today, the EVs are all the rage. And while it might take years before these EVs outsell their gas-powered siblings, we find that this change is no longer happening slowly. And we see that China is actually set to lead this whole EV market. So EVs, they still remain a bit more expensive compared to conventional vehicles, but the cost of batteries are actually dropping, and it's estimated that about 100 USD kilowatts per hour, an EV will become as cheap to make as gas-powered cars. As such, we find the case that EVs are fast closing the gap and are becoming more competitive in terms of performance and cost than traditional vehicles, and this makes the transition to EVs well underway. Alongside this EV transition, we find advancements in a host of interconnected technologies, and this includes that of internet connectivity, battery storage capacity, as well as artificial intelligence, which have opened up the doors to the growing world of future mobility. So what I mean by future mobility here is that it actually refers to this whole broad concept about the future of transport and includes that of EVs, autonomous vehicles, as well as the sharing economy like e-hailing services, as well as distributed energy storage facilities. So going forward, this electric vehicle and future mobility industry, or EVFM industry in short, is one of the world's fastest growing industry. And we find that within this industry, China is in the lead. So China is the market leader in this whole EVFM space and is actually set to maintain this dominant position in years to come. So for instance, the country actually represents close to 50% of the global EV market in 2020 and has also achieved immense success in every step of this EV supply chain, such as from the upstream mining of raw materials, such as lithium, to that of battery manufacturing and vehicle production by original equipment manufacturers or OEMs, or in more simple terms, these are essentially your vehicle producers. So firstly, when we take a look at the upstream mining of raw materials needed for the EV transition, we find that China has strong upstream lithium mining capabilities. So you see here the chart, China is one of the top 5 countries in the world in terms of lithium reserves. And lithium is actually a key raw material component of today's rechargeable EV batteries. And over the years, Chinese companies such as Jiangxin Gulffield Lithium, encouraged by Chinese government's attempts to dominate this whole lithium market, have actually grown to become a significant player within this whole lithium mining segment. So today, the company is the 3rd largest lithium compound producer in the world, and is also a leading producer in China. And moving down the supply chain to that of battery producers, we also find a similar case where China dominates this whole global production of lithium-ion batteries. And again, this is a key component of the EV/FM industry. So it's forecasted to account for about 69% of the production by 2029. And if the current trends actually continue, most of the world will likely use Chinese batteries. And a clear beneficiary of this trend is no other than that of Chinese EV battery giant, contemporary Apparex Technology, who's also the largest battery maker in the world. So lastly, when we go down to the supply chain, to that of downstream original equipment manufacturers, who are essentially your EV car producers, they have actually no doubt benefited from this highly developed domestic EV value chain. And this arises from China's strength in critical components such as raw materials as well as the battery production. So in fact, these OEMs, they're actually rapidly expanding their annual production of electric cars and are on pace to make more than 8 million vehicles by 2028. And if you take it one step further, many of these OEMs within China, they're actually looking to launch new features as well as vehicles that will push the boundaries of this whole idea of vehicle automation. So we see that the China OEMs have actually been witnessing a record new development over the recent years. So for instance, XPeng looks to challenge Tesla in China with their own semi-autonomous driving technology. So this is known as the X-Pilot 3.5, which is also their latest version of the XPeng's advanced driver assisted system. And this is a car that's actually capable of handling city driving scenarios. So having mentioned all of this, one way in which investors can go about gaining exposure to China's fast-growing EV industry is by this Nikon AM Straits Trading MSCI China EV/FM ETF. So I know the name is a bit long. And this is the ETF that was also the first China EV ETF that was listed on the XGX exchange. And the ETF actually aims to replicate the performance of this MSCI China All Shares Future Mobility Top 50 Index. And they essentially track the companies that are listed in Hong Kong, China, as well as the US, who are expected to derive significant revenues from this whole EV/FM industry. And the ETF is also available in 2 currencies, which is that of the SGD and the USD. And so Singaporean investors can actually gain easy access to this ETF by the local currency. And the ETF comes with an expense ratio of about 0.7%. And again, to get a better picture of what exactly you're investing in, if you buy into this ETF, here are the top 10 holdings of the ETF. So there are many recognizable names, some of which are briefly touched on just now, such as that of Contemporary Apurex, NEO, as well as BYD and Jiangxin Garfield Lithium. So for the final ETF today, we'll be sharing more about a fixed income ETF. So in China, there's actually been a shift towards, in terms of policy, towards that of monetary easing. And monetary easing in particular would benefit that of government bonds. And so we'll take a look at why exactly is China government bonds something to consider investing in, especially in this current environment. So China is a different place compared to many of its global peers. And unlike many of its global peers, the People's Bank of China has maintained this accommodative monetary policy. So rather than increasing interest rates, they actually have cut their key lending rates. And this has been a first in almost 2 years. And all these are amidst concerns about economic slowdown. And this is dragged down by the property market in China, as well as that of a strict zero COVID policy, which could potentially slow the economic growth. So moving forward, in this year, this is a especially crucial year as there's an event which will actually determine whether President Xi Jinping continues for another presidential term in late 2022. So in view of this event, we feel that China would actually take measures to actually stabilize the economy in view of the weakening economic growth in face of these multiple headwinds. So China is likely to roll out more policy measures, and this would mean that there's a strong case to be made for the People's Bank of China to actually keep an easy monetary policy. As such, we actually expect an increasingly divergent monetary policy between that of US and China for the rest of the year. So we all know that the US Fed has actually started to raise interest rates from near zero to actually curb the persistent inflation, which has been ripping through the global economy. Meanwhile, the People's Bank of China will continue easing in the first half of 2022 to support its slowing economy. And the more rate cuts within the China economy would actually be good for the prices of China government bonds. So again, unlike the US, China's inflation remains manageable, and inflationary pressures in China have actually dropped due to falling food costs. So based on some of the latest figures, on the latest Fed data, China's consumer price index only grew 0.9% year on year. And meanwhile, inflation in the US has actually hit its highest and fastest pace in nearly 4 decades, with the CPI climbing by 7.9% in February 2022. So while inflation in China is actually forecasted to stand at about 2.2%, in the US, there has been estimates that it's been forecasted to stay elevated at about 6%. So currently, looking at the chart, you can see that China government bonds have a nominal yield of about 2.78%. And after adjusting for inflation expectations, Chinese government bonds, they offer a real yield of 0.58%. So I think it's worth highlighting that Chinese government bonds, they offer positive real yield. And this is now rare to find in most of the major economies, as you can see here above. On top of this, another thing that is also worth noting is that China has a sovereign credit rating of A+ by Standard & Poor's, and this Standard & Poor's S&P, and this is comparable to that of certain developed economies. So while other large Asian economies such as Indonesia and India, they do offer higher yields, investors should also take note that these higher yields might come alongside a higher credit risk, especially in these two other major economies. And besides these higher yields, Chinese government bonds, they've shown that historically they have a low correlation with that of the global peers. And this enables them to provide diversification benefits. And which is why we also believe that in this kind of environment, Chinese government bonds, they do deserve a place in a global diversified portfolio. And this low correlation between that of Chinese government bonds and global peers have largely been attributed to the fact that the performance of the Chinese government bonds, they are mainly driven by domestic factors such as interest rate movements in China. And this has been vastly different from the rest of the world, as illustrated in the past few slides. So compared to the rest of the world, China is in a very different place at the moment. So moving forward, as China's economy matures, with their financial markets opening up to that of the global economies, we find that China's government bonds, the correlation with that of global bonds will be expected to rise. But given China's independent monetary policy, we believe that this correlation will still likely to remain below that of major developed bond markets. So last but not least, these Chinese government bonds, they've actually proven to be a reliable safe haven assets amidst all this volatility within the global bond markets. So the bonds as gauged by the FTSE China Government Bond Index, they've actually gained about 7.3% over the past year. And when you compare this to that of global investment grade bonds, as represented by this Bloomberg Global Aggregate Index, they've actually lost about negative 6.6% during the same period. So you can say in a sense that these Chinese government bonds have actually outperformed that of its global benchmarks. So looking ahead, the global bonds will continue to face near-term headwinds due to the tightening of monetary policies seen across major economies. Hence, from a monetary policy perspective, China is a totally different place compared to the rest of the world. And amidst the global rising interest rate environment, we believe that Chinese government bonds, they actually provide an area of opportunity for investors. So investors who are seeking a pure play exposure to Chinese government bonds, they can consider investing in this ICBC CSOC FTSE Chinese Government Bond Index ETF. And this is essentially an ETF that tracks the FTSE Chinese Government Bond Index, and they comprise of fixed rated government bonds issued in mainland China. It also comes at an expense ratio of 0.25%, and is available in both SGD as well as USD. So overall, Chinese government bonds is a fixed income segment that is not to be ignored, that should not be ignored. And the easing of policy in China will likely do well for the prices of Chinese government bonds. Additionally, despite rate cuts, the yield of Chinese government bonds, they remain attractive, especially when you compare them to developed bond markets. And coupled with this low correlation with the global bonds, we believe that investors, they stand to benefit from an allocation to that of Chinese government bonds in their portfolio. So to sum up, here are essentially the three ETFs which we have shared today. So given the steep sell-off in Chinese tech stocks, we think that valuations are now too cheap to be ignored, and this serves as a good opportunity to buy into the sector. We also recognize the strong fundamentals of the tech sector and how the regulatory risks should likely to be easing going forward. Hence, with all this being said, we recommend this Lion OCBC Securities Hang Seng Tech ETF. Additionally, when we look at to where China is heading going forward, we are increasingly upbeat on China's EV sector. And again, this is due to the alignment with the government's long-term strategic priorities as well as the country's dominance within this whole space. And not to mention, the sector is also fertile ground for growth, as EVs will likely take a majority share of China's vehicle markets over time. As such, we recommend this Nickel AM STC MSCI China EVFM ETF for investors who are interested into investing within this whole EVFM space. So last but not least, for those fixed income investors out there, from a monetary perspective, China is a totally different place compared to the rest of the world. They are likely to keep an easy monetary policy in order to stabilize that of the economy. And this would do well for the prices of Chinese government bonds. And coupled with the low correlation with global bonds, we believe that investors stand to benefit from an allocation to Chinese government bonds within their portfolio. So hence, we recommend this ICBC CSOC FTSE China Government Bond ETF for those fixed income investors out there who are looking for perhaps an ETF to invest within this space. And one can actually go about investing in all these ETFs via fsm1.com. And if you prefer to invest in these 3 ETFs mentioned above via a regular saving plan, rather than go about making a lump sum investment, you can also opt to do so with as little as $50 per month. So with this, I actually come to my presentation. So I'd like to thank you again for joining us and for your kind attention.
Chloe, I'm just wondering if you can take a few questions from us before you run.
Sure.
Okay, so we've actually got quite a few questions from our viewers. If you have any questions you'd like to ask Chloe about China, about these ETFs, please do enter them in the box on the right side of the screen. If we make reference to the Slido box, that's actually the Q&A app that we're using. So just type your questions in, and also do click on the thumbs up to let us know which questions you'd like us to answer the most. It'll be a very easy guide for us. So Mr. Saravanan is asking Chloe, you mentioned this earlier, but I think it's worth reiterating your views on the delisting risks of Chinese stocks in the US, or these ADRs.
Okay, sure. So in terms of delisting risk, of course, it's become an issue that's increasingly talked about, especially in recent days with the news that perhaps Futu as well as Weibo are some of the companies that could be heading for delisting. So in terms of this, we feel that it's not something to be totally or completely concerned about, as many of these ADRs are fully fungible, which means that they can actually be converted or sold from one marketplace to another. So if you have an ADR in the US market, it could easily be converted to the stock in the Hong Kong exchange. So let's take, for instance, that of Alibaba. So in terms of these kind of ADRs, I think there's not much to be concerned about, as eventually, if these delistings do eventually occur, which also is about 3 years from now, you can actually convert these shares from that of US being US listed to that of now being Hong Kong listed.
And also, Chloe, last night there was this great news for Chinese stocks actually about the possibility of Chinese regulators sharing information from the audits with their US counterparts. Do you have any insight into that news? That broke on CNBC last night, I think.
Yeah, so it's quite an interesting thing. I think it shows that Chinese government is perhaps being more accepting to this kind of working in the US counterparts. And I think hearing of such news would actually be good news for these China tech stock investors. It's a good move going forward. Yeah, and it's actually, I think, will kind of alleviate some of the investors' fears.
But some of those viewers who are hearing this will be thinking, so when did they announce this? So folks, they announced this after the Hong Kong and China markets closed, obviously, because it was going to move the share prices. So Chloe, the question I have for you is it too late to go and buy on Monday?
No, it's not too late. So definitely, especially looking across various valuation matrix in terms of the PE ratio, you'll find that China tech stocks, they're very attractive. And these are all recognizable big name companies which we all kind of have exposure to, such as Alibaba, right, Lazada, as well as Tencent. I think these are very reputable names. And so looking at valuations still, I think they're likely to be trading at a huge discount. I'm not sure what the prices will open on. Yeah, but currently they're really trading at huge discounts from the historical, perhaps like the fair PE multiple. So there's actually an opportunity to actually double your investment. That's how I feel going forward. I think this is a good crisis to actually take advantage on.
I can confirm what Chloe says because I have fairly decent positions in China stocks and they are at a discount, folks. They really are. Okay, so the next question from Winston. Winston is asking, does the Hang Seng Tech ETF pay dividends? What's the yield? Before you answer that, I just want to say that, usually for growth tech stocks, dividends is not such a big thing, right, Chloe?
Yes, this is the case because of the high growth that this business see. They tend to want to reinvest their earnings into their business itself rather than pay them out to investors. So when it comes to this kind of ETF, you shouldn't be expecting a yield. Yeah. So if you do want to expect a yield instead, I think a REIT ETF is a good place to start. But if you want to achieve a higher growth or perhaps a greater upside in terms of your investment returns, I think the tech place is where you should be.
Yeah, they're not so much income stocks, folks. These are growth
Yes.
stocks. So the income stocks, you want to worry about the dividend yield.
Yeah.
This is capital gains territory, folks.
Yes, definitely. Yeah.
Also, Chloe, related to that dividend yield thing, is
Okay.
recently Tencent, because I received dividends in scrip for Tencent in JD stocks. So
Yeah.
what Tencent did was they paid the dividend of one JD stock for every 21 Tencent stocks you held. And I ended up with these horrible odd lots. So I've just got like this handful of JD stocks now. It's less than 100, obviously. I don't know what to do with it. What happens though if you're in the ETF? Because we're talking about the ETFs, right? So for the ETFs, what happens when the dividend is given out in scrip rather than in cash?
Okay, for this kind of issues, basically, you have to go to find out by the ETF provider. So basically, different ETF providers will perhaps treat this kind of issues differently. So it's pretty subjective to the different ETF providers. So I suggest that in such incidents, to go and check out your ETF provider's website or perhaps the webpage. It's how they deal with the issue. This kind of issues would be quite different.
And I just want to add that if in the ETF you get it as, because it's NAV, right? You get it as cash. It's so much better than having to deal with odd lots inside your brokerage account. Like, what am I gonna do with this? Make it 100. Yeah. Okay. Next one from To YY. How liquid is the Hang Seng Tech ETF compared to the other, like the CSOP ones that were listed? Notice that those listed in Singapore have lower trading volume. So what are your thoughts on that, Chloe?
Of course, when you compare this Hang Seng Tech Index, is essentially Hong Kong's essentially the largest tracker of these tech names. So when you compare to that of the iShares Hang Seng Tech ETF, which is listed on Hong Kong, you definitely see the difference in trading volumes. But do note that if you want to go about investing in the Hang Seng Tech Index by Hong Kong, the ticker code is actually 3067. It's actually in the Hong Kong denominated currency. So basically, if you're using this Lion OCBC Hang Seng Tech ETF, you could actually do so in that of SGD. In terms of liquidity, there's still quite I think not something an issue to be concerned about. Yeah. So the Lion OCBC Hang Seng Tech, the ETF has also been one of our top sellers.
Yeah, I also, full disclaimer, folks, I'm also an FSM1 customer. I've been for over a decade. So yeah, I do a lot of trading there. They're okay, their volumes are okay.
Yeah, it's not something you should be concerned about. Just that, of course, you cannot compare our volume for this ETF to that of the Hong Kong listed one because of the markets as well. So the Hong Kong Stock Exchange has a much wider, as well as more people investing in that whole stock exchange. So you're definitely going to see a difference in this volumes wise.
For those of you who are not as experienced in investing, generally speaking, if you don't need to be exposed to Forex risk, don't lah. The Forex risk is an additional factor on top of your investments that you shouldn't have to worry about. For those who are more experienced, they're like, yeah, I want some exposure to Hong Kong dollars. Sure, please go ahead. Next question for you, Chloe, is from John. John is saying he's worried about upside risk for China being capped because Western sentiment has geopolitical risks. That there seems to be this sort of division between the West and the East again. And China's position of neutrality with regards to Russia, Ukraine, is adding to that. So there's a risk, he's asking, of Western capital shunning China either due to ESG issues, geopolitical risks, and this might lead to depressed valuations. So yeah, it is upside limited because of these factors.
Okay, so with regards to this kind of issues, I think a lot of the valuations have already been priced in. So when it comes to the stocks, they're currently trading at attractive valuations. And I think there's expected to be much volatility ahead. I think it's not surprising given that this is China's stock market, which is also why we encourage investors to perhaps take a more long-term view when it comes to this, for instance, investing in China tech names. Because ultimately, China has a very wide as well as large domestic market. So they're able to actually grow from their own domestic markets itself. Yeah, so it's not, definitely it's an issue to take note of, but where China's tech stocks are currently trading, I think a lot of these issues as well as regulatory risk has already been priced in, especially when you see what has happened in 2021, where that of crackdown was like the main word in the whole of the China stock market.
Yeah, folks, I'm one of those super lucky people who picked up Alibaba at the absolute bottom at 71.25, and the prices have just shot up since then. But even after that, we're still below IPO price. Can you imagine? We are below Alibaba's IPO price now, even though we've gone up something like 30-40% in a very short amount of time. So keep that in mind. Valuations, like Chloe has been saying, are incredibly depressed. Okay, next question is from John. John Xia is asking, will the EV stocks be considered expensive because of their PE ratio being very high? He's worried that there might be a correction for the sector. What do you think, Chloe?
Yeah, in terms of correction for the EV sector, I think recently we've already seen a correction in terms of this sector. So I think the stock prices have dropped by, I think, more than 20% within this whole sector. And of course, when you talk about the EV sector, which is kind of the sector which is to a sector that is in the future. So all these high growth sectors, naturally they come with high PE, but how this high PE is actually justified is based on their earnings growth. So currently, we actually expect to see that China's EV market will actually grow tremendously, because by 2035, all Chinese people will actually have to buy an EV or hybrid vehicle within China if they actually want a car. So what this means going forward is that this EV market will become the dominant market in years from now. And so these EV companies will actually achieve this tremendous earnings growth, because of where they are in now. They are in a very high growth industry. So to answer your question on why this sector is expensive, it's because of the strong earnings growth. And if you're a long-term investor, you'll find that eventually the PE ratio could perhaps be more acceptable because of this strong earnings growth that's seen over the years.
Wow. So yeah, folks, sometimes people like to say that China's centralization can be a problem, but it makes some really tough things possible to just, enact a regulation like that, and the whole country has to follow 1.4 billion people. That's a big deal. But speaking of EVs, they need chips.
Yes.
Semiconductors, the supply chain issues are nightmarish. China, despite having trying their darndest to create the most sophisticated chips, they're still very reliant on TSMC for the highest technology implementation. So will China be able to keep up? Is SMIC going to get their act together anytime soon? What do you think?
Yeah, so recently you see the case there's also a huge opportunity within this whole China semiconductor space, because the government is really devoting a lot of resources to develop their domestic industries. So you see names like SMIC or Will Semiconductor, they're actually trying to keep up with the global players within this whole chip industry. So while they currently lag behind, we see a lot of opportunities for growth, surely because of the fact that the government are actually investing a lot of resources, and they are aiming for self-sufficiency in the future because they do not want to be reliant on these US chip makers, or perhaps because of this, especially these US trade tensions.
Yeah, because we all know what happens. Every 4 years, the president changes over in the US, and suddenly policies can change rather drastically, as we saw during President Trump's reign as president. So the next question is about inflation. This is from John. He's actually asking a fairly general question. So this is about why Chinese inflation is lower than US inflation, because his assumption is that because of globalization, an increase in commodity prices would drive inflation similarly across the world everywhere. But how is China and Japan keeping their inflation so low? Chloe, can you shed any light on that?
Okay, so we have to remember what happened during the COVID-19 crisis. So one of the first few countries to actually recover from this crisis is that of China. Yeah, so China is actually, so now you see that other economies like US is recovering as well as rebounding pretty fast from this crisis, but China is actually one of the first to have actually recovered. So you see that it's kind of inverse at the situation now, where China, because of their zero COVID policy, they've actually likely to achieve this, actually like going to see this slower economic growth because of how they're dealing with this whole COVID crisis. So this is where the difference in the monetary policies come about, where you see that US, on the other hand, is rebounding really strongly. And that's why you see things like rising inflation, as well as commodity prices, as well as talks of the Fed needing to raise interest rates to deal with all these problems, while China actually was the first to recover and are now facing different issues compared to the US.
Okay, so Chloe, next question for you. While I'm asking the question, can I trouble you to bring up the slide again? Anna is asking, can we see the slide again for the top 10 holdings? So I'm going to ask our tech team, can we allow Chloe to share that slide? We want to see the top 10 holdings for those ETFs. Is that possible? Oh no, this is the other one. Okay, we might need to stop sharing.
Yeah, I have to stop sharing. I can't share at the moment.
Okay. Yeah, so that Chloe can share. Okay, never mind. While they're working that out. Okay, Chloe, can you try sharing your screen now? So you see the top 10 holdings for these ETFs.
Can you see my screen?
Yes.
So for which ETF? The first one.
I think Hang Seng Tech first lah.
Hang Seng Tech, sure.
Yeah. So now that we're taking a look at that, okay, I think it's useful now to go to this question, which a few of the viewers are asking about common prosperity. Common prosperity is this wonderful policy which is trying to, it's a very direct, very sort of, I would say, very blunt approach towards approaching the income inequality issue. It aims to close the income gap. But then it does affect these companies because it is a direct redistribution of wealth from the companies. Is there a common prosperity discount that we need to apply to these stocks?
I think like what I mentioned earlier, I think a lot of all these risks, as well as this whole uncertain regulatory environment within this China, has already been priced in. Because these are issues which have already came out. So investors are all aware of what is happening at the moment. So you'll find that a lot of these issues will be priced in, and many of times the valuation now actually reflects all the risks which investors who kind of really take a note of. And going forward, I think I mentioned earlier that the Vice Premier of China, his name is Liu He, he actually came forward to reassure investors that the government will be perhaps more open, as well as won't continue with their immense crackdowns as we've seen in 2021 going forward. And this has actually helped to reassure many investors. And you can see that in how the prices of Tencent and Alibaba actually rebounded about 20% just after the announcement was made on 16 March. So with regards to a lot of these questions of regulatory risk, I think a lot of the downsides have already been priced in. And going forward in 2022, we do expect to see much more, perhaps a better environment for these Chinese tech stocks, and because of the fact that China also wants to achieve this challenging economic growth of 5.5% this year.
Wow.
And yes, and so
Very ambitious.
Yes, it's a pretty ambitious. They said this, they mentioned this whole goal. So perhaps that taking into consideration where China wants to be, as well as what has happened in the past, I think this is something which has already been taken note of, and I think going forward the future looks a lot brighter.
But China has a very good track record for these things. They say that's the target, they hit the target. No matter what, everyone will be like, huh? Wow, that's the target. Wow, so ambitious. And they'll hit it. They will hit it, which is quite impressive. Now, related to this, because we talk about the government wanting this to happen, actually the companies are also defending their stock prices because some of them have started stock buybacks, right?
Yes. Alibaba has started stock buybacks.
And there are a lot of analysts over on Wall Street saying now that it's a great time to get into Chinese stocks because there's going to be more stock buybacks for other companies. I mean, do you agree? Do you really?
Of course, I agree.
This is a wave of stock buybacks.
Yeah, as a contrarian investor myself, I think that every crisis comes with a good opportunity. And I think these companies themselves have seen that, currently where their stocks are trading at, it's a pretty depressed valuations, and also are seeing this good opportunity to buy back the stocks and perhaps return more wealth to the investors.
Yeah, so every possibility there. If they've got lots of cash, especially on hand,
yes,
to do with it. Yeah. So folks, we're not. I mean, these are the ETFs, lah. So you don't have to go and do your own research and then okay, which companies have more cash on hand? All right, so buy the ETF is a lot easier. Jerry has a very straight up question for you. He wants the iFAST house view on if I can only choose, very binary, between the Hang Seng Tech ETF and the EVM and the EV1. Which one would iFAST recommend, Jerry?
In terms of upside, in terms of looking at upside, we definitely think that there are more opportunities for the Hang Seng Tech ETF because of what I mentioned earlier, as well as if you want to take a long-term perhaps position, this is a good ETF to buy at the moment.
Okay, then a question from interested investor, always very interested. Thank you for asking so many questions. The zero COVID policy, and this has really been a massive problem when you can shut down Shenzhen,
Shanghai
and Shanghai, and make oil prices fall, from these shutdowns. The zero COVID policy, it's going to be a massive drag on China in the short term, isn't it?
Yes, definitely. But do note that I don't think this zero COVID policy, the Chinese government might change their mind, saying that they do have this goal of 5.5%. They might be thinking that, it doesn't make sense in the long term, and there might be a reversal of this policy. And do note that with regards to this Omicron variant, this is a variant that is pretty mild. So in terms of China opening up, you could see a recovery pretty soon. So this is not such a deadly variant in the sense. So in terms of recovery, we do expect to see that sooner or later, Shanghai as well as the various lockdown cities in China would likely open up. Yeah. So
we pray also that the death rates will be very low, that this will clear up as quickly as possible. We're really, I've got family over in China. My cousin's there with his family, so yeah, it's really a difficult time for them there. We're hoping that passes soon.
Yeah, we're hoping for a change in policy, perhaps saying that zero COVID policy is not something which is sustainable or in the long term.
Yeah. Okay, Chloe, one final question for you. This is from Anne. You might want to bring up the bonds holdings, because they're asking, CYC, does it include only the central government bonds? Are there municipal, provincial government bonds, off-balance sheet bonds also included in that ETF, that bond ETF?
Okay, I don't have the holdings because these are bonds. So essentially, this CYC invests in government bonds. So I think we'll find these, whichever the corporate things, these municipal entities, or that, it's likely to be inside. But do note that in terms of these CYC, Standard & Poor's is actually assigned an A+ credit rating. So in terms of the default risk, it's actually likely to be pretty low or almost non-existent. Yeah, so this is not a sector which it's not like China's property sector. Yeah, you wouldn't expect to see default risk. This is a pretty stable sector, and I think it's reflected in the yield also. So it currently has a 2.78% yield, which is still higher than that of developed economies, but I wouldn't exactly say it's a super high yield also.
But I think everyone else was, I was pleasantly surprised to hear that it was up 7% in a year. I'm like, wow.
Yes. Precisely because of the fact that unlike US, China's undergoing this monetary easing, and monetary easing is good for the prices of bonds.
Lovely. And on that note, thank you so much, Chloe, for your time. We've really appreciated you sharing about the whole of China, talking about the ETFs. And it's really been such a great time having you here for this session. Thank you so much, Chloe.
Thank you very much. Happy to be here today. Thank you.